Did the Fed just quietly shift the momentum in the mortgage market? Are we finally seeing signs of real movement? Or is this just more of the same sideways stall that we've been stuck in for weeks? Well, if you're planning to make a move in real estate this spring, you can't afford to miss what just happened and what's coming next. Hi, I'm Mike Petras with MPRE Boise, powered by NextHome Treasure Valley, and I break down weekly mortgage rate updates so you can make informed real estate decisions in Boise, Meridian, Eagle, Nampa, Caldwell, Kuna, Middleton, and Emmett. But before we dive in, please hit that subscribe button below, hit the notification bell so that you're constantly in tune with the videos that I do come up with. And if you do enjoy this video, please give me a thumbs up. Also, if you figure that this information could be useful for somebody else, please feel free to share it. And if you're looking to make a move right here to the greater Boise, Idaho area and are looking for more information before you do, please click in the description below, download my free relocation guide, or simply just scan the QR code right here over to my left. So let's get into it. This week, mortgage rates had a more sideways to slightly improving feel compared to the previous one. We started off the week with average 30-year fixed rates sitting around the near 6.7 range on Monday. Bond markets opened quietly with early trading reacting to weaker than expected retail sales data, but that optimism faded once the control group data came in stronger than forecast and rates held mostly steady as lenders priced conservatively. By Tuesday, some modest bond improvements gave lenders room to slightly lower rates by the end of the day, especially after the 20-year bond auction that helped fuel demand. Then came Wednesday, Fed Day, the big day that I had mentioned from last week to watch out for, and we all braced for the fireworks. But what we got instead was a subtle bond-friendly message. The Fed held rates steady as expected, and the summary of economic projections showed no aggressive upward revisions to future rate expectations. They also announced that they would slow the pace of their balance sheet runoff, which is a fancy way of saying that they'll be reinvesting in more bonds. A technical but important move that helped mortgage rates actually improve. As a result, Wednesday afternoon saw lenders reprice for the better. Rates dropped to the lowest level in over a week, very close to the best levels we've seen since mid-October, and Thursday continued that momentum. Even though the bond markets were relatively flat, lenders priced more aggressively thanks to Wednesday's late-day rally. Friday, today, however, was quiet, no major data, just some headlines about potential tariff flexibility. Bonds faded slightly through the day, and lenders mostly held rates flat or bumped them up just a hair. We ended the week slightly better than we started, but still squarely in the familiar range we've been tracking since early March. The biggest market mover this week, though, was clearly the Fed meeting and the SEP update. While there were concerns that the Fed might respond to its recent sticky inflation by raising its long-run rate forecast or hinting at fewer cuts in 2025, well, that didn't happen. Instead, the dot plot reflects 2 cuts this year, and Powell's tone was relatively measured. That kept markets calm. The Fed announced that they would slow the pace of the Treasury runoff starting in April, and that was a technical win for mortgage interest rates, and that's because more bond demand equals lower yields, which equals improved mortgage interest rates. Even if that doesn't directly translate to a rate drop overnight, it sends a message that the Fed is trying to tighten further right now. And meanwhile, economic data like retail sales, builder confidence, and jobless claims gave us a mixed picture. Some weakness, some resilience. That blend continues to support the idea of a gradually cooling economy, which is exactly what the Fed wants to see before it can cut rates. So what is coming next? Should you lock in now or should you wait? Well, we're still in a fragile range. Mortgage rates aren't tanking, but they're not surging either. This past week reinforced that rates can drift lower when the Fed shows restraint and the economic data doesn't surprise to the upside. So should you lock in or float going into next week? Well, if you've got a deal in contract and your numbers are working at current rates, locking in now is not a bad play, especially with Friday's minor bump reminding us on how fast things can reverse. If you're still shopping or aren't ready to move just yet, there may be more room for rates to improve next week, particularly if the data comes in soft. But as always, it's a gamble. But what we're looking out for next week is there's a full slate of data to watch. Monday kicks off with the S&P Global Flash PMI reports for both manufacturing and services, early signals of economic activity that could influence sentiment. Tuesday brings on the Case-Shiller Home Price Index and consumer confidence and new home sales, all directly tied to housing and buyer sentiment. Wednesday features durable good orders, a key indicator of business investment. Thursday is jam-packed. We've got jobless claims, a second Q4 GDP revision, and advanced trade numbers and pending home sales, especially relevant stats for real estate pros like myself. But the most important day of the week next week is going to be Friday, when the PCE index, the Fed's preferred inflation gauge, is released. We will also see personal income and spending numbers rounding out the Fed's inflation consumer behavior picture. Now, if the PCE report comes in hotter than expected, don't be surprised if rates tick back up. If it cools, we could see another leg down. Either way, this coming week could set the tone for rate direction as we head into April. So while the mortgage market remains unpredictable, staying informed is still the best way to make smart financial decisions. The Fed may have calmed markets for now, but next week's inflation and housing data could stir things right back up again. So what do you think? Will the PCE report surprise to the upside, or will we get more evidence that inflation is finally cooling off? Drop your comments below and let me know your thoughts. And remember, hit that like button if you enjoyed this content, and hit the subscribe button below, hit the notification bell so that you stay in tune with videos like this and stay ahead of the market. And while I am just a realtor and not a lender, if you are thinking about buying or selling in the greater Boise, Idaho area, I can help. Or if you're thinking about relocating to Oregon, Washington, California, Nevada, Arizona, Tennessee, or Florida, I can connect you with an experienced lender that serves those areas. Feel free to reach out anytime. Well, thanks again for watching, everybody, and I look forward to seeing you again next week for another mortgage rate update. I look forward to the day that we speak. God bless. And I look forward to the day that I call you my neighbor.